All right, everybody, it's Sunday. So first up, Molly asks me two. You get a bonus here. Two VC Sunday School questions. The first one is about what's the rational way to deal with an overheated market, whether it was crypto last year or climate, the category that Molly has dedicated herself to today. Great question, Molly.
Thank you. And then I got to spring one on him because I just still don't totally understand warrants. But after this conversation, I do, which is great.
Excellent.
And then we have former journalist Nat Bullard on the podcast to talk about moving to Voyager Ventures as a venture partner, investing in early stage climate startup.
Wow, sounds familiar. From journalist to investor. I see a trend emerging. Thank you, Michael Moritz and O'Malley and Molly Wood. It's going to be a great show.
Stick with us.
This Week in Startups is brought to you by Blueground is revolutionizing the rental game with its global network of designer furnished apartments that can be seamlessly booked for a month, a year, or longer. Get up to $1,000 off your booking with Blueground. Visit promos.theblueground.com/twist for more info. Feel at home, free to roam with Blueground.
Paperclip. In a downturn, every dollar counts. See where your firm's cash is going and stay on top of your runway with Paperclip. Go to getpaperclip.com/twist to get the app free for life. And LinkedIn marketing. To redeem a free $100 LinkedIn ad credit and launch your first campaign, go to linkedin.com/thisweekinstartups.
Hey, everybody, it's Sunday. I hope you had a restful weekend, thinking about your career, maybe blocking out some of the bad news in the world, and thinking about something great, Molly, which is building companies. It's virtuous to build a great company that solves a problem in the world, creates jobs. You are now a free market capitalist monster, correct? How has the transition been for you?
Definitely. Capitalist vulture up in here. I actually was at an event this past week, and I did a million panels at this event. But one of the things I did, it was Verge 22 by this outfit called Green Biz. And they put on, it's very, very business and finance focused conferences about climate. This is specifically a climate tech event. So I'm very excited to say I already have 4 startups in my inbox as a result of this one day on the ground.
Fantastic.
And got to spend the whole day with like my number one favorite sci-fi author, Kim Stanley Robinson.
Oh, wow.
It was a great day, but I did a lunchtime event called Will Capitalism, this was my title, Will Capitalism Kill Us or Save Us or Both? And ended up with a table full of investors and startup founders in the climate tech space. So first of all, good job me. It was really good bait. But it was a very interesting, I think we kind of landed on both. Because we're all like, well, we feel really great about this.
You're good at naming things. You have a talent for packaging of media there. It's why we're going to have to see where you can take that, pull that string and see where it leads us. Because you're good at like making a splashy
I'm pretty good at branding, and branding and titles.
Never trained in it, but you just have that ability. You just
I think of myself as a translator in general, right? Like I'm like, take your complicated topic and I'll boil it down to a few words for you.
How we survive. Okay.
Translation. So anyway, that was a long way of saying, yes, I'm all in.
Great.
On capitalism. I love the motivations. It's just clean. It works. You know where you're going.
Yeah. I mean, if you look geopolitically, I've made this argument a ton of times, including on All In, when, last year people were like, I guess, maybe it was Friedberg was like, oh my God, China's going to, wall up the US. And I said, I have to pull this clip so I can do one of my pulling of the clips like Chamath does. But I have this great clip where I said, listen, I think dictatorships always wind up imploding and they have their own problems and they overreach and capitalism always wins. I'm not worried about America, basically. And sure enough, here we have it. China is becoming super insular. Ain't nobody in China want to start a company after they saw what happened to Jack Ma and all those companies losing their value. Like, what's the point of being an entrepreneur if it's going to get you in hot water? It's hard enough. Like, imagine if entrepreneurship was a quick road to being, put in jail or whatever happens to people in China when they get too powerful.
Absolutely. I should probably say that I'm still enough of a public radio hippie that I do not believe in unregulated capitalism. I think unregulated and that's where the kind of climate tension comes in, because unregulated capitalism is just complete consumption until we all die, right? And so this kind of idea of rules matter. Public-private partnerships really matter in the climate space. but also talk about rampant capitalism. We're in this moment, and I've made this joke a couple times that like about timing in life. For once in my life, I have timed this particular career move perfectly.
Yes.
Maybe because climate tech investing specifically right now in this weird moment of downturn, this gets to the VC Sunday School thing, is out of control. Like the slowdown in funding does not seem to have hit climate tech investing. There are so many new funds. There's so much money. It's still like totally competitive. You know, we had a company that was destined for the accelerator all of a sudden get this huge term sheet. What do we do? What is this normal for like one part of a venture ecosystem to be like 100%. Wildly out of whack out of step with the rest?
Sure. It really does happen from time to time where you have irrational exuberance from the capital allocator side and perhaps even overfunding and not enough entrepreneurs. So if there's only a small number of entrepreneurs pursuing a vertical, let's say it's like the Stable Diffusions and the Open AIs of the world, AI kind of creating images and words, there are a small number of opportunities to place a bet there. People are enamored with it because the technology, when you see somebody use DALL-E or Stable Diffusion or GPT-3, you're like, oh my God, that's incredible, right? So you want to place a bet. You're sitting on a bunch of chips and everybody wants to place a bet in the same space. There's more supply of money. There's a lower supply of companies. So therefore, demand for those companies is really high, would be the best way to say it. And so since demand's high, the price goes up because entrepreneurs are smart and they want to have a marketplace and they'll go for the highest price. So what do you do in that situation is you have to be disciplined, because if people overpay for a company early, then the company has to do what's called build into the valuation. So to give an example, if companies pre-product, they don't have a product completed, they don't have a product in market, those are typically valued 10 million and under. They could be an accelerator, they could be seed invested, so 10 million and under. Then they have a product in market and they have some people using it. Okay, now you could see them getting 10 to 15 or 20, depending on what amount of traction, right? And you can put a multiple of cash on it, like how much revenue they're making. But just broad strokes, let's say under 10 if you don't have a product, over 10 if you do have a product. Well, what happens if there's so much demand that to win a deal, a VC says, you know what, I'll just give you credit for what would happen in the next round in this round. So what would that look like? Well, instead of investing $1 million at a $10 million valuation, I'll give you $2 million at a 20. So I'm still buying 10%, but I'm paying twice as much for it. Why would a VC do that? Because there's competition and they want to get in on the deal. And what should you do if you're one of the people who doesn't get in the deal? Well, you just wait, because they're going to need more money. And in order to justify the $20 million valuation, they're going to need at least $1 million in revenue, 20 times revenue, maybe 500,000 if the market's really hot, 40 times revenue. So you can just wait it out. Wait till they hit 30 or 40K in revenue, build a relationship with the founder and say, hey, I see that, you now hit $500,000 to $1 million in revenue. Probably a good time for us to talk about maybe doing your seed extension or your actual Series A. Is that something you might be interested in? And they're not going to be able to say, well, give me 100, because people are going to look and say, well, you have $500,000 in revenue. That would be 200x. That doesn't make any sense. Yeah. So gravity will eventually bring all of these companies and valuations back down to earth. And you just be patient.
It is kind of interesting how there is, even in a down market, always bubbling. Because like I brought up climate tech and you brought up AI. That's a group, like a little bubbling bubble right now. It sort of feels like. And
for sure.
So one of the things that was discussed at this conference a couple of times about the investing space and how much money there is, I was kind of gratified because I'd been hearing this, these whispers about how like climate tech is still really competitive and valuations are still higher. And there's like a lot of, I don't want to say tourist money, but there are a lot of new funds.
Yeah.
And new investors such as myself.
Yeah.
What happens when kind of like crypto or SPACs, like a bunch of bad things may get funded here?
Correct.
And then what does that do to the category? Do I have bad timing after all?
No, I don't think you have to. I think this requires patience. And it's very hard to have patience when you're sitting there with a bunch of chips. It's the equivalent of, hey, I want to go to this restaurant and it's been open for 30 days and it just got this incredible review. And now it's booked out, right, for 60 days, or you have to wait online for 3 hours. And then you go in the afternoon for lunch and you arrive first and there's no line. And you're like, wait a second, this thing has a 3-hour line. It's like, yeah, not at 3 p.m. So in between lunch and dinner. So you basically have to look at the situation where this place is overbooked and say, well, what is a place where I could enter? How could I enter this? Well, there's a couple of different things you can do. One, you can be patient with that company and wait for it to, start executing, because then they actually have to hit the numbers. If they don't hit it, well, now you're talking about maybe a down round or a flat round. If they do hit some level of numbers, you'd be looking at only a modest increase. So keep the relationship with the founder. Send them notes, give them a retweet, and just build relationship fabric. Because I've seen over and over again, VCs pass on a seed stage deal, pass on a bridge, pass on the Series A, and then do the Series B. You don't there's probably 5 or 6 chances to get on the train. Yeah. And if you could get on the train for Google anywhere between the seed round and the Series B, you'd be happy, right? You'd be happy to get on that train. So just keep that piece in mind. And then maybe go find other startups that are going to compete in the space that are more nascent, right? So you can just look at who's going to compete with that company and just get a full version of the field. So in the case of Stable Diffusion, right, raising 100 million at $1 billion, you know there's going to be 10 more entrepreneurs who are going to see that valuation and have their own spin on it. Get into one of those companies early, and now you're still in the category. So you missed Uber, but you did Lyft. People who invested in Lyft got an incredible return. Or you got DoorDash, or you got Postmates. All 3 of those Series A's or Series B's were unbelievable investments. So if you missed Uber, and people did, like Andreessen Horowitz, they got into Lyft. Or famously, Sequoia did DoorDash, right? And other people did Postmates. So you don't have to hit the Uber in the category. You can hit the other 3. Remote work is here to stay. We all know that. And I'm sure a ton of you are listening right now and you've gone fully remote. And a lot of remote workers love living that digital nomad lifestyle. Don't I know it? You see me during ski season. I'm out there doing the executive CEO, a little 90 minutes of skiing in the afternoon, skip lunch, eat it at your desk. Well, if the nomad life is for you, and I know it is, you need to check out Blueground. Blueground is a network of stunning, move-in ready apartments that come with everything you need to work remotely. They manage over 10,000 apartments across 15 countries and 27 cities in the US, but also Europe, the Middle East, and Asia. Here are some of the cities they're available in: Copenhagen, Barcelona, Madrid, London, Dubai, Paris, Vienna, waits for you, Berlin, New York City, LA, Austin, Miami, and so many more. And they're super flexible. You want to stay for a month? No problem. A year? No problem. A couple of years? No problem. A quarter? You pick. You're in control. And you can browse all the available apartments in real time. Book in a few clicks, and you move in as quickly as the next day. You can manage your entire stay and enjoy a nice concierge-style service through their guest app. Yes, if you need something, they're there to help you. They make apartments available where you want, when you want, and on the terms you want with Blueground. Feel at home and be free to roam. And here's the best part. Get up to $1,000 off your booking at promos.theblueground.com/twist. That's promos.theblueground.com/twist for up to $1,000 off.
That's a really interesting point you brought up too, about how I think that probably I have started to bias heavily toward get in as soon as you can, as cheaply as you can. And you seem to be saying like sometimes clearly, right? That's what to do, and it's the most ownership. But that there may be times where you're like, this is a really promising pre-seed round. I'm willing to pay a little more, or I'm willing to be a little later and own a little bit less so that I can see this prove itself out and get to seed.
You nailed it.
See, this is a good one. This is a good class today. Good class.
Well, I mean, if you take the situation you're describing, so let's say you found this company, they were going to go to the accelerator, they got a seed deal. Great. Maybe they even used the accelerator offer to get the seed deal. Great. That's within a founder's right to go shop a deal. I mean, sometimes they have no shop clauses on them for this reason, but anyway, I'm fine with it. You know, somebody gets a better deal, you're happy for them. Mm-hmm. Now you just stay in touch with them, and you look at the companies that are in the category around them, because it's usually, if it's a good category, again, there's not going to be one, there's going to be 10, and you'll find an opportunity to place a bet in the space. And so you just need to be patient. You don't want to place a bad bet. And this company that then did the seed round, they're taking all the risk, Molly.
Yeah.
They paid a high price. They do all the risk. And then you can just jump on after the risk is proven out. So Bill Gurley probably made the most money from Uber. He didn't do the seed round and take the risk like Chris Sacca and I did. Now, in hindsight, sure, of course, it's a great bet. But he got to let us fund that $1.5 million, take the risk, and then he got to do the Series A. And then Menlo did the Series B. They let Benchmark and the seed investors do the seed in the Series A and take the risk. The B was still a great deal at $300 million. Mm-hmm. So there's going to be opportunities. Be patient. Don't overpay. Have some discipline. You can overpay on the margins if it's a truly fantastic founder / idea. But I think overall, discipline and meeting with more companies, understanding the whole space is how you combat this. That was your original question. How do you combat irrationality?
Exactly. How do you combat irrationality? Exactly.
Patience is one, and thoroughness is the other. Because you're going to, what are the chances if you met with 50 companies and this one out of 50 got this like overpriced deal? What are the chances they're the one? It's possible, but statistically not probable. So let's look at the other 49 and make sure we understand all of them, and that we're checking in with them every 3 to 6 months. And that is the way you're going to find out of the space. Again, you missed Uber, but you understood on demand, you understood the power of mobile, you understood the power of delivery. You really had a prepared mind and understood those dynamics. Great. Lyft, Postmates, DoorDash, all did wonderful. So you just place a bet in one of those.
Or maybe you waited out, you skipped Webvan and waited for Uber.
Yeah. I mean, actually, it's funny you mentioned that. Bill Gurley did Webvan and then did Uber. So the prepared mind and the losses of Webvan led to doing Uber.
And maybe doing Uber a little more cautiously too. Fascinating.
Well, Bill Gurley did Good Eggs as well. So he made 2 bets on a space where he got walloped previously. So
it is interesting too, because it's also, I mean, it is the way of venture, I think, to be riding early waves in general. So like climate tech is a really early space where you start like, it's, there are 10 businesses in this category, right? There are lots of different measurement things. There are lots of different this type of thing. There's this and this and this, and they're all kind of like growing, and you're looking for the signals that suggest that one of them might be a winner. That's also happening in AI right now. That was also happening in cryptocurrency. Like, it sort of sounds like really with any brand new category that everybody's running to, the so-called VC lemming effect, the advice is always the same. Like, play tight at the beginning of the poker game until you know what the table looks like.
That would be a great way of saying it. And then just to put a pin in this, I just sent you a link. Why the clean tech boom went bust. There's a story from Wired, right?
Yep.
And you're like, okay, well, this looks like an interesting story. Let's read it. Oh, yeah. Let me just check when it was written. Oh, 2012.
Right.
So, there was John Doerr, Khosla, Solyndra, all of these things that happened in that first wave that you can learn lessons from. And of course they overpaid. Of course it was too early. And if cryptocurrency is going to be a thing, probably now is the best time ever to invest in it. After having bought Bitcoin or Ethereum when those projects were first launched. So that was probably one entry window, buying those, in the first couple of years, Bitcoin and Ethereum. And now the second window is emerging now. I don't know if you saw the story about Chris Dixon and the portfolio over this. There's a big story that just came out.
It was in the New York Times, right?
Was it? Yeah. And so Chris Dixon, really nice guy, by the way. I'm a fan of Chris Dixon. And he went all in, and it looks like massive losses for Andreessen Horowitz, who apparently, talking about timing, went in at the wrong time. It's a Wall Street Journal story.
Oh, yeah, it is. Yeah.
Andreessen Horowitz went all in at crypto at the worst possible time.
Ouch.
So now what you could do is, here's how to strategize this. You look at everything Chris Dixon, who is a smart individual and was a great founder and a good product person. You just look at every bet he made. You look at all the collapse valuations of those, and then you would look at that portfolio and say, well, he's smart. He probably picked some good projects in there. Let's go through those projects and see if there's a winner, and see if they're doing a down round, or they're doing a round where they're giving 10 warrants for every share you buy, which means it's 10% of the price, right? And that's what will happen is out of this, poorly timed portfolio in all likelihood, if that's what's happening here, this could be a poorly timed portfolio, just like the other, climate ones were,
like
but
the
in that same,
you could almost cut and paste chunks of that John Doerr climate 1.0 into this one, and then listen to John Doerr on our show saying that $1 billion worth of investments then is worth $3 billion now.
Right. And so which one is worth it? Now, if you were to look at that same time period, you know who's in that cohort? That's one of the most successful companies of all time, Tesla. So, and if you were studying that in 2012, when that story was written about the collapse, Tesla in 2012 was, I think, public by that time and was probably trading at 1 or 2% of what it is now. All right. And so, Molly, if you did invest at the time of that Wired story in 2012 in Tesla, you would have had a 245x. So they had about a $2.9 billion market cap in October of 2012, and they got a $710 billion market cap today.
Wow.
So, oh my Lord, in sometimes the collapse of an industry, if somebody does survive, we saw this with Amazon, you see it with other companies, to the victor goes the spoils. And so
I love it too, because it's not what I love about that is that at the time, all the FOMO, all the froth, all the bubble was about solar. Mm-hmm. And Tesla came out of that, right? So it's like, it's just such a great lesson that it is so easy to follow the school of fish to green hydrogen and fusion and the whatever it is. And it's like, no. Look where they're not.
Yeah. And it goes back to what I always say, nobody knows. So if you can find a reasonable bet on a great founder, you make as many reasonable, thoughtful bets on as many amazing founders as you can find. And that's the name of the game. It's exactly analogous to this Andreessen Horowitz story.
It is.
I bet you inside of crypto, there are 3 or 4 in this huge pile of heaping fire and rubble. 2 or 3 mother of dragons are going to come out of there, right? 3 dragons are going to come out of that.
3 dragons are going to come out. Oh, that's so fun. And famously, Dor did Fisker instead, like passed on Tesla. So, it's, you could literally lead the category. So Chris Dixon either, and we will only know in 10 or 15 years, probably, Chris Dixon either picked Tesla or Fisker, right? Somewhere in this portfolio. Both. Maybe both. Yeah.
Maybe both. This is the thing that's so crazy about our industry. As an investor and a capital allocator, you need to place as many reasonable bets as you can, understanding that you don't know. And that's what I'm teaching to our, 22-person team twice a week for 2 hours during those investment meetings is let's find every reasonable opportunity we can and place a bet. And if it goes well, triple down on that bet. That's the name of the game. And just have the humility to know, okay, this is a reasonable bet at a reasonable price with a reasonable founder, with reasonable product market fit, all those things we look for. Okay, this is a reasonable bet. Now let's, move on and study the results of those early bets to increase our position in them. And you just have to have that humility. The humility I've come to, in my second decade of this is make bets on any reasonable, opportunity you can and triple down on the winners. Mm-hmm. And just study your process and try to make your process, 10% better a month. That's literally what I'm committed to. I'm just going to try to be a 10% better investor every month by being more thoughtful, doing more training, and then you place as many reasonable bets as you can because overall the category wins. The category of venture capital historically has won. So just get in the game and be thoughtful, and that's what you're doing. You don't have to sweat any one. You don't need to hit everyone. You need to hit one. So,
it's so funny because your advice on this segment and elsewhere has been effectively exactly the same since the first day. And it has been, be patient. Put the FOMO in the box.
Yeah. And FOMO is how you get yourself in trouble.
And now there's massive FOMO in the specific vertical that I'm in. And it's going to be, in a way, it's amazing, right? Because it's like an extra crucible. Here we are in a bit of a downturn, but then there's a bunch of FOMO here. And so it's the discipline that I feel that I will learn in the next 2 to 5 years will be incredible because there's going to be so much push to go the other way. Can I
ask
a bonus VCSS question?
Absolutely. I think, by the way, I would even take your 2 to 5 year window.
Yeah.
And I'd look at it as a decade-long journey for yourself. 2 to 5 years of learning, and then the next 5 years of learning, and then 5 years of being on top of your game. And if you take a 10-year view of it, what's the rush here? There's no rush. Just get to know as many people as you can. Get to, take as many meetings as you can, learn as fast as you can in those first couple of years. And then, place as many bets as you can on any reasonable opportunity. Your follow-up question is? Bonus question. Here we go, folks.
Yes, I want to be clear. I actually just told somebody yesterday, I was like, I can't wait to just go insanely hard for 10 years. Just run as hard as I possibly can on this for 10 years because I'm so energized by it and into it and thrilled by everything that I'm it is the coolest job ever.
Yeah.
I feel like the 2 to 5 years are the years I will be just actually on fire.
Yeah, for sure.
Just take
as many first round meetings as you can get is what it's about. Just shooting as much playing time as you can get. Those meetings are the playing time. Be very liberal with meetings. Take as many first round meetings as you can. If it's not a fit, just get comfortable saying, hey, not a fit for us at this time. We make very few investments, but it was great to meet you and love to stay in touch. And the more of those 30-minute meetings you can get under your belt, it's a couple a week, then to 10 a week, whatever the pace is, just want to get to know you. Hey, maybe it's
just
for the
like
show.
A quilt. You're just weaving it in together. Yeah, exactly. For the show, like the whole thing. Okay, so my follow-up question. Well, I don't understand. I'm still working on warrants. I keep reading about warrants.
Sure. Warrants
and I just don't get it.
Okay, it's very simple. A warrant is the right to buy a share at some time in the future at a predetermined price. So if I give you a warrant right now to buy Facebook shares, and it's a public company, but let's say Facebook was private and was trading at the $100 it's trading at today. I say, you have a warrant for the next 10 years to buy a share for $100. You'd say, or let's just say for 110 and it's trading at 100 right now. You'd be like, okay, so if I buy the share, I lose $10. It's like, yeah, that's right. But what value does that warrant have? The right to buy a $110 share of Facebook when it's trading at 100. Well, it's a free option because if the company grows 10% a year, it will go to 110 and then 121 and then 134, whatever it is, right? 10% compounding. All of a sudden, that warrant has some value to it and you can execute it at any time and you do not need to put any money down for it. So this is a magical thing. Now,
why would
it's kind of like stock options, right?
It's like stock options in a private company. Why would a company issue? It's not a fundraising mechanism.
Is
just like a pot sweetener.
It's a pot sweetener, yeah. And it could be for a partnership. So let's say, you've got a company, let's say like a Sale Plan, right? You got a company like Sale Plan that you invested in, you're on the board of, and they do this thing in shipping, right? Where they're monitoring emissions from ships. And let's say, I don't know, the number one maker of ships in the world says, hey, we'll build this into our ships. We'll build your sensors into the ships in some, incredible way. We'd like the right to invest $1 million in your company at this valuation. Let's say it was a $100 million valuation. But we're not going to give you the $1 million. We just want the right to do that in the next 10 years at the $100 million price. Let's say there were 100 million shares, so each share cost $1. They would have the right to buy 1 million shares for $1 each anytime in the next 10 years. So it costs them nothing. And the company might say, well, this costs us nothing right now. It would be 1% dilution and we get to be in every ship. So all we have to do is have the person who bought the ship, turn it on and sell them the software. It's already built into the ship. All these sensors are all over the ship already. Okay, great. You have this option to buy those shares. And in fact, I wouldn't be surprised if a company like SiriusXM or Sirius, which then merged with XM, either one of them said to Ford, at some point, hey, if you put our satellite receiver and satellite into every single car, we'll give you the ability to buy 1 million shares for $1 each. You have the warrants. Doesn't cost you anything now. And if you have the option, if this works and a bunch of people buy SiriusXM subscriptions, you're going to make tens of millions of dollars. So it's a free option. It's a way for the company to give other people skin in the game who maybe don't want to put cash in.
How often does that come up in venture deals?
Not too often. Not too often. It's usually used in business deals, but in a down market, it is a way for people to change the valuation, the effective valuation of the company without changing the valuation of the company. So you invest at 100 million, you put $1 million in, and then we give you 9 extra warrants for doing it at 100 million. So essentially you paid, you got the million in warrants, you got the 9 million in warrants, you paid $1 million for 1%, but you actually have 10% of the company. So, it's the equivalent of paying a much lower valuation.
I see. So that is why I'm starting to hear the word warrants come up more because we're in a down market and those scenarios are coming
kind of like it's another way to do a liquidation preference without putting a liquidation preference on the books. And so when you invest in a company, you say, hey, are there any outstanding warrants? Let us know about them. And that's a good thing to know. Right? Like maybe the company's given 10% of their company away in the future. So you just have to factor that in. Okay, if I'm paying the $100 million valuation, there's 10% of these out here. Maybe I should be paying a $90 million valuation. Or what impact would that have when the company goes to get public and this person executes those warrants? So it's just a financial device to let people buy equity in the future if they want to, but they're not obligated to do so. And they typically time out. So usually you have the warrant for 10 years. So you have 10 years to execute the warrant.
Gotcha. Thank you. Amazing. I get it.
You get it. Simple.
So blog posts are not as easy as talking to humans, turns out.
That's nice to, when you're on the treadmill, if people right now are on their Peloton treadmill, you can be listening to this pod and you learn a little bit. And, so I'm not, by the way, I'm not perfect in all this regard. I'm in my second decade of investing. If I get something wrong here, you can email me anytime, jason@calacanis.com. If you have a question that you want us to address, producers at thisweekinstartups.com.
That's right. All right. And then next up this week in climate startups, this is actually very well timed because, again, while I was at this day-long death march of awesomeness, I was interviewed by another podcast about the transition from journalist to VC. And as it happens, today's guest on This Week in Climate Startups is a journalist who became a climate tech VC. Journalist Nat Bullard came on the podcast to talk about his recent move to Voyager Ventures as a venture partner. Voyager invests in early stage climate tech, and Nat does this really good newsletter at Bloomberg Green, focusing on energy, transport, technology, climate, and finance. So it's like a cool transition to VC, but also just in terms of that translation layer, he's writing this really, it's what I have been discovering a lot is that the storytelling aspect of this is still a really big deal. And 100%. This is a great mashup of that. So,
all right, everybody, enjoy the interview.
Not as good as I'm at it, but guys, pretty good.
Enjoy the interview. Founders, when you know your numbers like the back of your hand, you're going to come across as super credible. And when you're super credible, you're going to close investors and you're going to close customers, right? And credibility, I say this all the time, equals closing. And Paperclip is going to make you more credible right now. It's a free instant financial dashboard that puts all of your most important numbers at your fingertips. You plug in your bank, you put your credit card in, your financial accounts, and Paperclip gives you instant access to the most important metrics, like your net cash, your burn rate, and your runway. These are the numbers that you need. It's like being a pilot. You got your altitude, you got your speed, you know your GPS coordinates. Well, when you know those coordinates, you can be a better pilot. I want you to stop wasting time crunching numbers in spreadsheets or waiting around for your accountant to close the books. All of this information is at your fingertips if you use Paperclip. So here's your call to action. See why thousands of startups trust Paperclip to help manage their finances. Check out Paperclip and get real-time visibility into your financials today. It takes less than 5 minutes to set up, and Twist listeners get the app for free for life by going to getpaperclip.com/twist. That's right. It's typically $30 a month, but at my link, it is free for life. There is no downside, literally. So go to getpaperclip.com/twist today.
Nat Bullard is Bloomberg NEF's chief content officer and somewhat recently, I hear, became a venture partner at Voyager Ventures, investing in early stage climate tech companies. Me too. Let's have the whole journalism to investor talk. But first of all, what's Bloomberg NEF?
Sure. So let me begin with a little qualification on that, which is that I was the chief content officer. Now I just stepped back into a role that is purely looking at the climate, mostly from an externally facing perspective. So Bloomberg NEF, for reference, or did spend 15 years, is a research shop. Started as a startup itself in 2004, covering the very early stages of what then was emerging as clean tech. It was acquired by Bloomberg in 2009, made its way sort of through the stack of global emissions and markets related to climate. And I spent 15 years with them. I joined in 2007, one of the first hires here in the United States. Took it a bit on the road once we got acquired. The minute that we got acquired by the shop in London, where our team was, I realized I want to move to the West Coast. So I moved from DC to the West Coast, moved from there to Hong Kong, now back here on the East Coast. But we at Bloomberg NEF cover the whole thing. So we, as I said, we started really quite contained on the things that, say, a German investment bank would be asking you about in 2004, 2005. How does solar work? And instead it's expanded to really cover all the kind of key questions that you might have for the deepest decarbonization that's out there. But after all that time, after 15 years, I had seeing my title, I'd kind of reached the apogee of where I was going to go within that group. And in an important way, from a product perspective, where I'd spent a lot of time, and from a strategy perspective on what we're going to cover, kind of had tapped out. Like we'd done it. We were covering everything. We were at the point where the biggest companies in the world were asking us the most formative questions. And I kind of missed the game a little bit. So took a bit of a step back. So I joined the company in a new role, a contributor role. So basically doing public writing, assisting with some of our high level stuff, taking it on the road with some key conferences here and there. And that gave me the freedom to be able to do what I was very much interested in, as you are, which is to work with these early stage companies after so long. It's fantastic because I've got what I would hope to think are kind of a symbiotic set of processes and priorities here. The first one is I still write every week about climate. And I started off writing a little newsletter of my own devising in 2014. I remember it was 179 people exactly that I signed up for the first one. It finished last year at 175,000, and now it's going to about 220,000 people, in concert with some other friends at Bloomberg. Of course, it's not just me at this point.
Yeah.
But then the work with Voyager is a sort of fantastic add-on to go with that. It's my sort of chance to get way back towards talking to the earliest stages of companies. I was listening to your interview with Greg Dalton last month, actually, and you said a couple of things that sort of made me realize that we moved from this world of high production and intense focus across sometimes months and years to put things together. And now we kind of have to unwind that and take our insights and our ability to recognize genius and brilliance back down to the level of like a person with a PowerPoint deck.
Mm-hmm.
And it's really, really fascinating. It's quite a bit of a learning curve for me. In many ways, it's kind of like an unlearning to an extent of the sort of skills that you put in place for working with big organization, dealing with other big organizations for such a long time.
Yeah.
And now you're back to, how do I judge two students coming out of a lab? How do I also talk to somebody who might have spent 30 years doing this as a practitioner, but within, the belly of a very big industrial beast for a long time? So it's really refreshing. I'm doing these things both, in parallel. I do writing with Voyager. I do sit in on conversations where I might help troubleshoot something with a portfolio company or help a prospective investment to kind of see where the market opportunity might be. And then I'm writing every week. I don't know if you miss writing, but I know I would miss writing. I find it incredibly satisfying as a way to sort of shape my thoughts over time. And also to, keep me honest. It's, you're doing your work in public.
Yeah. I would love to miss writing, but we do a daily podcast and I'm trying to run this climate syndicate. So
right.
I'm not missing anything except sleep right now. But no, I do actually. And it's funny because I've got to I'm I have a piece inside me that wants to come out, and there's just not the 5 minutes or the place to put it. So the newsletter is just a great outlet. It's called Bloomberg Green, by the way. I don't think we said. How did you get hooked up with Voyager Ventures? How did that, we've all got our sort of origin story in terms of the arrival in VC. How did that
Mine's good. I've known Sierra Peterson, one of the founding partners, since New Year's Eve of 2005. We met just as she was on her way to beginning at the International Energy Agency. And when I was still in school, studying international economics and energy policy. And I wouldn't say we've exactly been on parallel tracks. I would say, honestly, Sierra's is much more distinguished than mine because she worked in the Obama White House after the IEA. She worked for some early stage companies. She's been an active investor for a long time. But we were at a moment when there really, to be honest, were very few people that were doing this worldwide. When her work at the IEA was looking at energy efficiency at a time when this was sort of, barely kind of on the radar. I was coming out of school and getting ready to go to work for a research firm when we received really the most elementally basic of kind of questions that you had to answer, like how do things work? Not just how big might the market be, but how might they work? And so Sierra and I have kept in touch over all of that time, corresponding, keeping up with each other's work. And we just entered a series of conversations as Voyager Fund 1 was approaching the close. And it was as always with these things, is sort of a feature of timing. It's about when you might have the time to have that meeting of minds and to get together and be able to talk. But also unique to find people who are, not in my case necessarily, but in the case of the other founding partners, still relatively young, but have spent the entirety of their careers doing this. And so there's not a lot of people that can put together a founding team of two people with 30 years of experience devoted purely to climate tech at this point. So that was a special opportunity. I knew I would walk in with sort of a high degree of symbiosis between the three of us, and also to be able to kind of hit the ground running. And that's definitely what's going on.
Yeah. full sprint.
Yes,
is what you're saying.
Right.
Yeah,
that's right.
Hey, everybody. I'm here with my pal, Tom Eschbacher. He is the Senior Sales Manager at LinkedIn Marketing Solutions. And today, we're going to talk about marketing for startups. And LinkedIn did a great new internal report called Today in Startup Marketing. Welcome to the program, Tom.
Thanks, Jason.
We've been talking about ICP, Ideal Customer Profile. This is a critical concept for all founders to understand. How can LinkedIn help with the startup figuring out who is their ideal customer?
It's hard to know, especially for companies who are really getting started. And one of the great ways that LinkedIn is able to help is by providing you additional insight on who's visiting your website from all channels, organic, paid, search, what have you. Our website demographics feature looks at the professional attributes, and I'm talking about the job function, job seniority, company industry, company size, even company name, to help you hone in on the audiences that are most engaged with your site. We can look at this down to the particular page so you can get product level insights. And what you're going to do is take that, share it back with your sales and product team, and add that to the anecdotes that they are bringing to provide a really holistic view of what an ICP can and should look like.
Fantastic. You can go to linkedin.com/thisweekinstartups and get the report for free, as well as $100 from Tom.
Talk to me about the thesis of Voyager Fund.
So the Voyager thesis is that there's money to be made in doing things that are going to drive the deepest decarbonizations that's possible. It's primarily, I would say, an economic
thesis. And then talk
thesis.
about, actually, I'm going to even back you up one more step. Can you define decarbonization for people who don't know what that means?
Let's start with deep decarbonization. Mm-hmm. And I'll do that into kind of like a sort of a 3 layers here. The first is, when I started working in 2007, was in this era of kind of renewable energy was this thing. This is where you're going to do wind and solar, you're going to do bioenergy, and if you're in Europe, you do some carbon markets. Flash forward about 7-8 years, and you can layer another thing onto that, which is sort of what I would call energy transition. That's, you've got a group within the company that's like, hey, turns out that we can get to 0 emissions in one part of our business. We should go do that, and we'll call it our energy transition strategy. So these layer up, and the next layer up is, and the final one really is kind of a net zero. Like, we're going to get ourselves to net zero emissions in the global economy by 2050. And that's different. That's not just like create a special situations group in your bank to finance something. And it's not just like, well, we have a strategy team that's working on something that might happen at the corporate level by 2040. This is like everything has to happen all at once. And it also has to happen at every level of the business and in every part of the business. So it kind of leaves you no out. There's no area that's sort of untouched in thinking about that. That's my thesis. Okay. That I think is probably not terribly controversial.
Yeah.
And I don't want to speak too much for the Voyager thesis.
Is controversial?
No, I wouldn't say that's controversial, but I would say that I think, you should get the Voyager founding partners on to tell exactly their take on it. But
yes, tell them they're welcome anytime for sure. And
they will be fantastic guests when you get.
Yes.
So
as a starting place, though.
Good. But the thesis there is that there are new levers to be pulled in things like food and agriculture, industrial infrastructure, of course, still things within energy, but also within mobility, within materials, where we need to go. First of all, they need to be invested in order to achieve a decarbonization down to like almost 0 net emissions in most processes. But also that there are business opportunities to be had there. That's kind of why I start with that, like there's sort of 3 layers, is that each successive layer of that has been an addressable market. And now the addressable market is essentially every big process that creates emissions within every company that does it everywhere. The trick, of course, is to hone that down into something that you can actually do. Right. And I think that sounds like a lot of meetings.
Yeah.
Yes. Like that's not an investment thesis. That's a principle essentially on which the thing is founded. I think, the thesis is that there are now new things that are addressable by virtue of technology and markets that weren't previously. There's a really rich landscape in which to be active. There are entrepreneurs that are, and this is me talking here, but I think this also wouldn't be controversial, are essentially climate natives. Like they have come up through this entirely. And to be honest, different from you and I in that sense, that like this is not something that they ever sort of had to view as either controversial or outside of the main. It's something that they went to school to study as undergraduates, as graduates, they've worked in it. And finally, that there's opportunity to make money in all of this. And I think that it exists obviously within a realm of climate as a thesis, and it exists in tandem with capital market and policy rotation towards that. But it is not dependent necessarily on an ESG lens or a particularly socially responsible frame in which to make that happen.
Mm-hmm. So lots to unpack there, but I guess the shortest response is, it sounds like what you're saying is that the investment opportunity is far beyond energy.
The investment opportunity is definitely far beyond that. I mean, there's one, which is there's an investment opportunity in energy in decarbonizing power in order to then use that newly decarbonized power to do other things. Mm-hmm. So like we're going to have just an insane amount more electricity generated from renewable energy, but we're also going to have like 4 times more electricity generated full stop globally by the middle of the century. A lot of that is sort of just inherent demand growth, but a lot of it is also that like you now need electricity to go and do the decarbonization of steel and cement manufacture. You're going to need that for processes where it didn't previously work. You're going to need it to make green hydrogen, all of that sort of stuff. So there's that, I think, is probably the first principle behind it, I would say.
How early stage are you? What's the what's the check size? Seed and A?
Yeah, seed and A.
And then what does that translate to generally in terms of check size? Do you lead like
good
VC
question.
Stuff?
Another one for the 2 founding partners, I think, rather than me. Not huge, and a lot of them are still stealth. So to be honest, there's probably not a lot of cover out there on that. I think they have led some. Definitely have co-led with others.
Great. What are you like as you look at this sort of suddenly much bigger universe? Mm-hmm. What's exciting to you within it, and then what do you think we're maybe wasting time on?
What's exciting to me is people who are sort of building their new business thesis around a notion that we will have much more abundant energy in the future as an input to other things. It's not quite a kind of like abundance narrative as such, but it's something like that. I'll give you a great example. In California, where I sort of did some of my formative years, where you still are, the grid is just not able to use a really significant amount of solar power at key months of the year. It's just a feature of the way solar has been built and the way that the grid operates. Mm-hmm. So this is a technical term. It's called curtailed. Basically, it's being generated by the panels. It's not going anywhere. Mm-hmm. And that's done on an economic basis. It's like magic. You just turn it off. It never happens. That's going to go up so much in the future, no matter how many batteries you put in place or how much transmission you do. But a better way to think about it is like what businesses are going to emerge around the notion that you can get either free or even negatively priced energy input that has no emissions. Like there's this universe of things you can do, and it's not just mining Bitcoin, which is, of course, what every guy with laser eyes on Twitter tells me that you're supposed to do with it. Like there's going to be something else that can come up with that. And the really cool thing is that unlock hasn't really been explored. Like that hasn't really been looked at yet because that hasn't really been a thing. Like you didn't have in the 1990s a thesis that said, well, people are going to pay me money to get energy. So what would I do with it? It didn't exist. And so therefore, a lot of sort of incumbent architectures are not really ready to think about that. So that's one. And then the other thing that's exciting is that people are now thinking way ahead in terms of solving really, really tough problems. Like the coolest thing for me is that my BNEF colleagues, when we catch up and I talk to them, are doing deep analysis at a market level on stuff that was like guy with ratty ponytail science experiment stuff even 10 years ago, but is now like part of a corporate consortium that's designed to make this sort of thing happen. And you start to see capital commitments go with it. And of course you can say that you flubbed it and we spent $2 billion of capital investment on something that it didn't work. That definitely happens. But that's not really the principle in which most of these companies are operating. They're saying we're putting together a complex governance structure, multi-party, multinational, but corporate, to go do something that's complex and was outside of frame, even 10 years ago. So that's really cool. What am I less excited about? I said that I'm not completely convinced of the full utility of a lot of Web3 solutions that are meant to address, in particular, the early side of carbon markets. I'm quite fine with NFTs in a different way. And that's because I was an art history major. And art markets have an incredible way of collating and processing manufactured scarcity. So actually, I think the long run for that, completely independent of anything related to climate, is probably fine. The challenge that I find with a lot of the Web3 things is that they don't necessarily make it easier to solve a problem for normal people, and they don't necessarily create much greater scale. And I say this coming from the experience of working for a giant financial services company that has clients that are giant financial institutions. You were asking an awful lot of them to go create a new market by going on chain to learn a new protocol and having to stand up an entire division that does that for something that may or may not actually end up having a lot of effect. And you have to layer into that all kinds of other things, measurement and verification. And then if you want to get into sort of thinking about it from a real banking perspective, custodianship, possibly building instruments like futures and forwards on top of it, all kinds of things that will need to be built are probably going to be built in ways that are interoperable highly with other systems that we have that aren't necessarily that exciting, but that don't necessarily go through a kind of a Web3 lens. I mean, my last thought on that is and I've listened to many of these things, and I always listen with an open mind, but are they using Web3 to solve a climate problem or climate to solve a Web3 problem? And to my mind, most of them are tending towards the latter. The explanation from a climate perspective is just very Baroque. And I think, therefore, kind of rate limited in terms of how far I could go.
Mm-hmm. Yes. The idea of using an alternative financialization mechanism. Yeah. Don't even get me started.
Right. I mean, think about it.
Look,
right.
We can already have a very spirited debate about the financialization of climate solutions, right? Whether it will drive adoption, whether it has to exist to drive adoption, or whether it's distracting us from, really hard tech and frontier tech. That's one conversation already. And then when you layer in the Web3 part of that and say, but it's going to be an alternate structure of extreme financialization of products who are of dubious value to start with.
And not just that, is it interoperable?
That's too many beers.
Exactly. Can you warehouse, you come at this from the sort of financial lenses that I do. Where is that? Who's the financial custodian for that? Right. Where does it get warehoused in the time before it becomes a full-on security? Who's the market maker behind it? All of these sorts of things happen. And, over time, all markets probably grow to the point that they become ideally boring in a constructive way. in a highly interoperable way.
Which is great.
Yes.
Speaking of markets, the reason that I ended up pitching the thing that caused me to send the message to the group saying hey, can we book this guy, was the piece you wrote about Salesforce's marketplace for carbon emission offsets.
Yes.
I want to ask you specifically about the Salesforce project, just because I thought you had such a great digestible write-up on it, but also from the investment perspective, how you're looking at carbon offset markets, because we're starting to see that's such an interesting area where I'm seeing pitches, and it feels like there's a lot of potential there. And it's the combo of Bloomberg and venture here that I think that makes you the guy to ask this question.
That's very kind of you. I had fun with that because it was a sort of an aha moment that I was looking for, and who's going to make this easier, not more complicated. Mm-hmm. And when I say that, it's not just easier in terms of it's easy to engage with, but that there's a sort of long chain of things behind it that have already been made easy. And by that, I mean that when I wrote it up, I said, okay, if you're a Swiss-based trading firm, you are definitely going to be able to get into the carbon markets because it's another esoteric, opaque, over-the-counter kind of thing that you're great, this is how I make money. It could be cocoa beans or it could be oil, whatever it is. It's going to be something that has asymmetries to it, opacity, and where my own calculations and capabilities are going to give me some kind of an edge. Also, it's not very big. Mm-hmm. That's fine. You can get in that market and play. But if you are a small to medium enterprise and you've been given this new mandate that you want to do some kind of carbon offsetting, do you really want your purchasing manager to have to go learn again, how to be on chain, to go sit through all kinds of different ratings and verification standards and learn all of these different things to serve what at first is a very thin layer of a purpose? And so I was thinking this is actually great because I can picture this meeting already. The boss's boss says we need to buy some carbon offsets. And you in purchasing is okay, what am I supposed to do with this? Am I going to take a month and figure this out? I don't have McKinsey and Bain money to have them tell me what to do. And I'm not a trading firm.
Mm-hmm.
And then the answer, I'm going to use Salesforce, is sort of elegant because Salesforce is already a payable for all of these companies. It's already an approved vendor. Like there are little elements in there that, especially for smaller companies, you will appreciate that. Like you don't have to go through all these new processes to do things. It's already there.
Yeah.
I think that's actually great because it expands this addressable market beyond the specialists. It does have it does create some natural cohorts of like, if Salesforce says that these are the standards that we support, then those kind of attract some things around them with their own specific gravity. What you can debate about whether or not that's good. I've sat through many methodological and verification discussions, and everybody says theirs is the best, or they say that it's the best for X. Over time, we'll see if those don't sort of, go kind of Pareto optimal and collapse into like the thing that works not perfectly for everything, but it works well enough for most things that it goes forward. And so I think that things like this are great. Do they sort of potentially close a venture window for the new carbon marketplace that everybody's going to operate in? Potentially. But they also create a much bigger addressable market for all of the other things that flow into it. Like if I'm a developer, my goal right now might be, I want to get my asset positioned so that it's visible in the Salesforce marketplace. That's a simple, like one sentence pitch that you can make to yourself, and that will have probably a handbook style set of steps that you need to do to get to that point. And I think that that's actually really good. You kick the innovation layer somewhere else. And I think that that's actually very, very healthy. One of the big challenges for these markets right now is that everything is in play. The assets that you are going to develop are in play. The way that you measure them is in play. The way that you transact them, warehouse them, the way that you securitize them, all of these things are in play at once. And that's tough. Like that's actually very difficult to do. Because if you're at any level of those things, you're dependent upon other people's own innovations that may not be running aligned with yours. So if you can marketplace these things, I think that that's actually great. You want it to become as normal as possible from a climate perspective so that it become as big as possible. Right. Now, these markets themselves, I mean, there's just so many potential things that can be done. I do think that we will have a lot of shaking out in the long term about what counts as good. It's sort of a rank ordering of like one company that says, I bought offsets from an old clean development mechanism hydro dam in Southeast Asia that's been running for 20 years is different from I'm funding geologic storage of atmospherically removed carbon dioxide. So I think that we're starting to see this qualitative aspect come in and not just quantitative. And you can also see this in the prices that companies use. The range of prices that people pay for offsets is anywhere between like a few dollars to many hundreds of dollars a ton. Right. And that's not because the market is inefficient. It's because there are many, many markets within it right now. And I think they'll shake out in the same way that related to that is that company internal prices for carbon range from like $1, which is essentially not really a price at all, to, if I recall correctly, $677 per ton of carbon, which is incredibly high price. That's way beyond what most economic modeling would say, but definitely is a price that would help, force some behavioral change.
And then finally, I want to ask you back to the fund. In Voyager's Fund 1 announcement, this is sort of speaking of this idea of tracking and quantifying. The announcement said across its portfolio, Voyager has a target of sequestering or averting the emissions of 500 million tons of carbon dioxide equivalent during the lifetime of Fund 1. How trackable is that? And how much is it a thing in the back of your mind? I mean, you're relatively new, but, in every meeting.
So it's
a question you ask every time.
The nice thing is that you can just straight up ask in any given pitch. Okay, for each unit of your own economic activity, whatever that is, like how much how much emissions are you abating versus what would otherwise be happening? If you're in the business of removing it, how much are you going to be able to remove? Like it's a nice sort of step ladder to be able to work through on the portfolio basis, while also, of course, kind of preserving some diversity of companies that you look at and different industries you look at. But it's nicely clarifying. Like it's another clear form of measuring what the fund needs to do, while also, of course, returning money to limited partners. Right. So I find that actually very helpful because it helps you target for scale and for relevance. So if something has a like fantastic economics, but a tiny addressable market, it's maybe less of a proposition from that perspective. Or if it's small at the moment, but you can see the path to it being 3 or 5 orders of magnitude bigger in the future, then you can get a sense for sort of the emissions reduction or removal capability that comes with it.
Would you say it skews you toward hard tech? Like, do you consider yourselves a hard tech firm?
So there's a lot of stuff in there that I think would still qualify kind of on the edge. So it's software based or it's transport based. A lot of it, of course, is driven by ICT in its way. I don't think you would call it hard tech in the like breakthrough energy ventures sense, because the timelines are, within a venture horizon. But it's definitely not exclusively huge things that are going to take 15 years to come to fruition. I mean, it has to have some things that happen kind of within fund lifetime to go. And so not that hard tech funds are necessarily requiring a 20-year window, but I think that there are activities within the fund that are happening with some fair immediacy. So, and not just requiring, another 7 or 8 years to get to lab bench phase.
Right. I'm calling this medium tech.
Medium to blended tech.
My strategy.
Yeah. I'll have to check with
honestly, blended tech could 100% become, heaven help us, leadership term.
All right. I can see that. I can see the offering documents already.
You're the guy with the newsletter. Let's make this happen. Nat Bullard is writing weekly for Bloomberg Green on energy, transport, technology, climate, and finance, and recently a venture partner at Voyager Ventures. Thanks so much for the time.
Thank you, Molly.
All right, everybody. Thank you for listening.
Yes, thank you. We have a great week coming up, a great Halloween week. We got Adina Heffetz from Divvy coming on the show to talk about that Fast Company hit piece.
Yes, that'll be great. And I'm interviewing my pal for the second time, the founder of AOL, Steve Case, on his new book, The Rise of the Rest.
I smell a book club coming, and we have an awesome drone startup for Next Unicorns.
All right, listen, tons of news as well is going to be breaking next week. Earnings, geopolitical, who knows what's going on in the world.
So Twitter might be bought by then.
Well, and if the Twitter transaction is closed, then I will be able to talk. And you know what I love to do, Molly? Talk. So maybe next week, Monday, could be the start of an exciting new This Week in Startups, where I can talk about certain companies that previously I was beep boop. Not able to talk about.
Mark your calendars.
Mark your calendars, everybody. Everything's going to be on the table.
See you Monday.